Welcome to Quality Trading Deep Dive. This is where day trading meets structure, discipline, and psychological control. Each episode is designed to shift your focus from impulse to preparation, from speculation to calculated execution. We break down risk management, valuation, and smart money context so your decisions are grounded in math, not emotion. Let's dive in.
Welcome back to the Deep Dive. Today, we are wading into waters that usually promise sharks, fast boats, and easy money. We're talking about trading.
Right.
But before you roll your eyes or, grab your wallet, I need to set the stage. We are not looking at the get-rich-quick side of the internet.
Thankfully not.
We're looking at a stack of notes, and it's titled The Beginner Psychology Reset. And honestly, it's a bit of a misnomer. They call it a beginner reset, but I was going through this thinking that 90% of the so-called experts I see on Twitter fail at these exact things.
Oh, absolutely. It's labeled beginner because it's foundational, not because it's simple. In fact,
Yeah.
most people skip this stuff because it's not sexy.
Right.
They want the complex indicators. They want the magic algorithm. They don't want to hear that the problem is, well, it's actually in their own head.
Right. And the source material opens with a premise that it stopped me cold. It says, trading is not about winning. It isn't even about avoiding losses. Which, let's be real, sounds like something a loser would say.
It does, doesn't it? I didn't lose. I just redefined success. But you got to bear with it. If you walk into the market thinking, I need to win, you're operating from a place of hope.
Okay.
You're already emotionally compromised because you have an expectation.
So if I'm not there to win, why am I there? To just donate money to Wall Street.
You're there to manage risk. The source argues that the shift from gambler to trader happens when you stop focusing on the upside and really start obsessing over the downside.
So it's about defining the loss before it happens.
Exactly. If you do that, the winning just sort of takes care of itself.
It's the difference between a guy at a slot machine screaming for a 7
Yeah.
and the casino pit boss who knows exactly what the house edge is.
That is a perfect way to put it. The casino doesn't hope to win. The casino manages the math. They are prepared.
And that's the mission of this deep dive. We want to take you from that adrenaline junkie mindset, which is frankly exhausting, to a mindset of boring clinical preparation.
Boring is profitable.
Exactly, and we have a toolkit to get there. We aren't just talking philosophy today. We've got a specific formula for fair value, which I know you have some thoughts on.
Oh, yeah.
We've got rules on position sizing that will save your sanity, and we have a very specific view on charts.
But before we get to any of that, the charts and the math,
Yeah.
we have to talk about the very first instruction in the source material,
I have to admit, I read this 3 times because I thought it was a typo.
the withdrawal rule.
Yes. The first decision, according to this guide, isn't pick a stock. It isn't learn a pattern. It is withdraw consistently, pay your bills, fund your life.
It's so counterintuitive.
It's more than counterintuitive. It feels wrong. I mean, I've read the books. Rule number 1 of wealth building is supposed to be compound interest. You leave the money in, you let it snowball.
Right.
If I'm pulling cash out every Friday to pay for groceries, aren't I specifically handicapping my account's ability to grow?
Mathematically,
Yeah.
on a spreadsheet, yes, you are slowing down the compounding curve. But, and this is the huge but that the source hinges on, you are a spreadsheet
You're a biological organism.
with a nervous system, yeah.
Okay, let's unpack that. How does paying my electric bill help my trading chart?
It's all about the psychology of desperation. The source is incredibly blunt here. It says, desperation collapses psychology. Think about it. If you have a bill looming, let's say rent is due in 3 days and you're short $500 and you turn to the market to solve that problem, what happens?
I force a trade. I see a setup that isn't really there because I need it to be there.
Precisely. You lose all your objectivity. Every tick against you feels like an eviction notice. You
Yeah.
panic sell at the bottom, or you hold on to a loser hoping it turns around.
The market can smell desperation.
It really can.
So the argument is that by withdrawing money and actually using it to fund your life, you're basically removing the gun from your own head.
Yes. When your lifestyle is funded, when the fridge is full and the lights are paid for, you can sit in front of that screen with zero pressure. You can wait for the perfect setup because you don't need to win today.
And ironically, that detachment is exactly what makes you win.
It's the paradox of desire. The more you need it, the harder it is to get.
So step 1 isn't about the market at all. It's about stabilizing your life outside the market.
Correct. You have to earn the right to trade with a clear head.
All right, I'm sold on the withdrawal part. So let's say my bills are paid. I'm calm. Now I'm looking at a trade. The source brings up risk to reward. Now, usually this is just a fraction. I risk $1 to make 3. Simple.
Just math.
But the notes say risk to reward is not just a ratio, it is a psychological anchor. What does that even mean?
It means that most people only calculate the reward side of that equation.
Oh, I'm so guilty of this. I enter a trade and immediately I'm thinking, okay, if this hits my target, that's $2,000. I can buy that new laptop. I can book that weekend trip.
Exactly. You are mentally spending the money before the trade is even closed. You've anchored yourself to the win. So what happens if the trade goes against you?
Well, now I'm not just losing money, I'm losing the laptop, I'm losing the trip.
Right. And that emotional pain causes you to freeze. You won't take the loss because you've already attached your happiness to the win.
So you have to flip it.
You have to flip it. You
Yeah.
define the risk, the loss before you click buy. You have to look at that potential loss and just say, I accept this. This is the cost of doing business.
That seems to tie directly into the next point, which is position sizing. The source has this great phrase, size light enough to stay unemotional.
This is the sleep at night rule.
But again, let me play devil's advocate here. If I size light, I'm not making big money. If I want to get rich, don't I need to bet big?
Okay, let's use an analogy. I want you to imagine a wooden plank, maybe 6 inches wide, laying on the floor right here in this studio. Can you walk across it without falling?
I mean, I haven't had that much coffee yet, but yeah, I think I could handle it.
Easy, right? You have perfect clarity. Your muscles are relaxed. Now, take that same plank, same width, same length, and suspend it between 2 skyscrapers, 100 stories up. Can you walk across it now?
Absolutely not. I'm crawling, I'm shaking, I'm probably crying.
But why? The task is exactly the same. Walk 10 feet. The physics haven't changed.
The consequences have changed. The risk is fatal now.
That is position sizing. When you oversize, you are putting that plank 100 stories up. You lose your clarity, your heart rate spikes. You make stupid decisions not because you don't know how to trade, but because the stakes are too high for your nervous system to handle.
So sizing light puts the plank back on the ground.
Exactly. When the position size is small enough that a loss is just an annoyance, not a disaster, your execution sharpens. You become a professional walker, not a terrified victim.
Execution sharpens.
I like that. It's not about avoiding risk. It's about managing the emotional weight of it. And that brings us to the tool we use to actually find these trades.
Yeah.
Because you can have great psychology, but if you're buying garbage, you're still going to lose.
This is where we get into the math, the fair value formula. Now, the source lists this as EPS, that's trailing 12 months, times the PE ratio.
Simple algebra.
Well, hold on. It looks simple, but when I first saw this, I thought, wait a minute. If I take the current earnings per share and I multiply it by the current PE ratio, I just get the current stock price.
Right.
That doesn't tell me anything. That just tells me what the market is doing right now.
You are absolutely right to catch that. If you use the current PE, you're just engaging in circular logic. The deep dive nuance here, and this is what the pros do, is that you don't use the current PE.
Okay, so what number do I plug in?
You use the historical average PE or maybe a target PE based on the sector. You are looking for a discrepancy.
Let's run a hypothetical so I can actually see this.
Sure. Let's say we're looking at Company X.
Yeah.
Over the last 5 years, Company X usually trades at a price-to-earnings ratio of 20. That's its normal state.
Okay, PE of 20 is the baseline.
Right. Now, you look up their earnings for the last year, trailing 12 months, and let's say they made $5 per share.
Okay.
So to find the fair value, you multiply the earnings, $5, by the historical PE, 20. What do you get?
5 times 20. That's $100.
Yeah.
So the fair value is $100.
Correct. That is your anchor. Now, you look at the actual stock price on the screen. Maybe the market's in a frenzy, some rumor about AI or something, and the stock is trading at $150.
So the price is $150, but my math says it's worth $100.
Exactly. The math tells you the price is stretched. It's trading on hype, not reality.
Right.
So even if everyone on Twitter is screaming, buy, buy, buy,
Yeah.
you look at your number and say, no, it's expensive.
And conversely, if the stock is trading at $80 because of some bad news panic, but the math still says 100?
Then it's do it.
Yeah.
You have permission to buy when everyone else is selling.
This changes the morning routine completely. The source suggests doing this calculation before the market even opens. Why is the timing so important?
Because once that market opens, the flashing lights start. The red and green candles, the ticker tape, the noise, it's all designed to trigger your emotions.
Yeah.
If you don't have that number written down on a piece of paper before the bell rings, you will get swept away by the momentum.
It's the anchor in the storm.
It's a lie detector. The market screams, this is worth 150, and your paper says, actually, it's worth 100.
Yeah.
It gives you the confidence to just sit on your hands and do nothing.
And doing nothing. That's a skill in itself. Which leads us to the map. The source talks about time frames, and this is another area where beginners usually get it totally wrong.
They're zoomed in.
Yeah, they're on the 1-minute chart or the 5-minute chart.
The noise.
But the source says the next major lesson is the quarterly chart, the 3-month view. Why on earth would I look at a chart where one single bar takes 3 months to form? That seems like watching paint dry.
It is watching paint dry, if you're looking for a dopamine hit. But if you're looking for the truth, it's the only chart that matters.
Why, though?
Well, think about how a company works. Do they report revenue every 5 minutes?
No.
Do they announce profit margins every hour? No. They report quarterly. The business cycle of a corporation is 3 months long.
Oh, that makes sense.
So the quarterly chart is the only time frame that actually aligns with the fundamental reality of the business.
The 5-minute chart is just traders betting against each other. The quarterly chart is the company's report card.
Exactly. I like to visualize it like Google Maps. When you look at a 5-minute chart, it's like using Street View. You see a pothole. You see a confused pedestrian. It looks chaotic. You might think, oh no, the road is blocked.
But if you zoom out to the satellite view...
That's the quarterly chart. You don't see the pothole anymore. You see that the entire highway is moving west. You see the flow of the entire city.
And in this analogy, the city is the institutional money.
Yes. We are talking about pension funds, sovereign wealth funds, mutual funds. These entities move billions of dollars. They don't buy based on a pattern they saw on a 15-minute chart.
Right?
They buy based on the quarterly data.
So when we look at that 3-month candle, we are seeing the footprint of the whales.
You're seeing the dominant trend. If the quarterly chart is going up and you are trying to short the stock on a 5-minute chart because you think it looks high, you are standing in front of a freight train.
You might win for a few minutes, but eventually the train runs you over.
Every time. The source calls this signal versus noise. The lower time frames are noise. The quarterly is the signal.
So let's assemble the machine here. We've funded our life to kill desperation. We've sized light to kill fear. We've calculated fair value to know the real price. We've checked the quarterly chart to see where the whales are going. Now comes the part that I think is the absolute hardest.
The exit.
Getting out. The source boils this down to a binary question, but I feel like it's so much easier said than done. The question is it overvalued or undervalued?
It sounds simple, but it requires nerves of steel.
Let's go back to our example. Fair value is $100. We bought it at 80 because it was discounted. Now the stock is climbing. It hits 100, then 110, then 120. The source says overvalued euphoria equals take profit.
Right. When the price extends significantly above that fair value line, that is the definition of overvalued. The math says sell.
But here is the problem, and I know every single listener has felt this. When a stock goes from 100 to 120, that is exactly when it feels the best to hold it.
Oh, it's a party.
The forums are exploding, your friends are texting you, the news anchors are talking about it, the euphoria is intoxicating, you feel like a genius.
And that is exactly why you have to sell.
Take profit when the math says price is extended, not when fear forces you to act.
That's the quote. The professional sells into the euphoria. They sell when it feels good to hold. The amateur holds until it turns around and starts crashing, and then they sell when it feels bad.
It's fighting human nature. We are wired to run from danger and stay with safety. But in trading, safety, that feeling of everyone agreeing with you, is actually the danger zone.
Exactly. When everyone agrees the stock is going to the moon, there is no one left to buy. The math has to be your sword. You cut the trade not because you're scared, but because the numbers say the probability has shifted.
And once you take that profit, we circle right back to the beginning.
You withdraw the money.
This brings it full circle. You don't leave it in the account to score points. You take it out, you buy the groceries, you pay the rent.
You make it real. When you turn a digital number on a screen into a tangible object in the real world, you close the psychological loop. You validate your work.
And most important,
You reset your desperation meter back to zero for the next trade.
it's a system. It's not a gamble.
It's an ecosystem of habits.
You know, we called this the beginner psychology reset, but as we've been talking, I'm realizing this is actually incredibly advanced. It's beginner only in the sense that it has to come first.
It's primary, not basic.
Exactly. So let's recap the checklist for everyone listening, because I want people to actually try this tomorrow morning.
All right, let's run it down. Step 1. Look at your bank account, not your trading account. Can you withdraw something? Fund your life to lower the stakes.
Step 2, check the quarterly chart. Where is the big money flowing? Don't swim upstream.
Step 3. Wake up early and do the math. Your EPS times your historical PE. Find that fair value anchor.
Step 4, if you enter, define the risk first. Size the position so light that you could walk that plank without shaking.
And step 5. When the price gets stretched and hits euphoria, sell, even if it feels good to hold. Especially if it feels good to hold.
And then rinse and repeat.
Rinse and repeat.
There's a final thought in the source material that I think is the perfect way to wrap this all up. It's about the philosophy of who you are in the market.
The hunter versus the prey.
Yeah. It says that the market is not a playground. It's a food chain.
That's the harsh reality. If you come to the market looking for excitement, if you're looking for a thrill, for a dopamine hit, or to prove how smart you are,
Yeah.
you are the prey.
You're the gazelle.
You are the gazelle prancing around in the open. The professionals will eat you alive.
Because they aren't there for fun.
No. They're there for value.
Yeah.
If you are looking for fair value, if you are prepared, if you are unemotional, if you are just executing a math problem while everyone else is panicking, then you are the professional. You're the hunter.
It's a choice. You can have excitement or you can have success, but usually you can't have both.
Boring is profitable.
That's the mantra. Listeners, thank you for diving deep with us. Take a look at your charts, but maybe take a look at your mindset first. We'll catch you on the next one.
Stay prepared.
Thank you for listening to Quality Trading Deep Dive. If this episode brought clarity, follow the podcast and share it with someone serious about improving. Stay connected. Instagram at qualitytrading.co, YouTube at Quality Trading Made Simple. This content is for educational purposes only and is not financial advice. I'll see you in the next deep dive.